Welcome back to the channel, Crypto Trend Trader with a quick update on Bitcoin. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, here I have the Coinbase chart. Currently, it's on the 15-minute, but I'm going to switch it over to the 4-hour for a little more relevancy. So essentially what we're paying attention to right now, what we have going on, we have this massive parabolic uptrend that started back at $10,000. We basically moved up along this green line here, and then we finally broke away from the green line and started like a full-on parabolic uptrend off of the already parabolic uptrend. So essentially like the slope increased, it got more intense, and we got further and further away from this support line that we had been basically oscillating as resistance and oscillating as support. And then when we bounce away from it, eventually we would expect there to be a reversion to the mean. So when we break down from basically this blue line right here, it no longer acts as support, so it's no longer blue. Now it turns to purple because it's going to act as resistance. So when we break down from that line, we get our move down here, find support at a key level based on like previous support that we had here when we sold off that initial 20%, based out right here, and then bounced up. We come down, break from this, come back and retest it, and then we get a reaction rally back to the upside. We've discussed how we determine like the targets for that based on our Fibonacci retracements and whatnot in previous videos. I urge you to go back and watch those. They are still relevant and there's still lots of information to be learned. When we came back up the first time, we retested that breakdown as resistance, found support at a higher low, and then came up again and once again broke through the resistance, but were unable to maintain it, and then we sold back off. We had essentially started putting in this channel with purple on top, yellow on bottom, and the heart line in green. So we had oscillated from the bottom of the channel to the top, from the bottom of the channel to the top and slightly out of it, from the bottom of the channel and then to the halfway point. And you'll notice the halfway point had acted as resistance as well as support a couple times along the way. Oftentimes what you'll see when we break a pattern like this, we'll see a move to the bottom, the top, the bottom, the top. We've now established with 2 points each, like a range. You'd want to see 3, but a lot of times on the third touch it will break. So when we come back down here, that's our third one. We come back to the halfway point and show weakness in the market, and then we come back to the bottom and we break. So when we break, we would now expect to get the measured move, which is this red target right here, which is going to take us back down to that $31,050 range, which is also the 886 of our green fib. So it's an 88.6% retracement from the bottom to the top right here. So basically, like, you know, without taking out the low and entering a confirmed downtrend inside of this macro move, you know, that would be like the maximum retracement that we could have, which lines up with our measure move in red. So then once we had established this top point right here as essentially a lower high from our macro all-time high, we came down and put in a low, then a high, then we came down here again, but didn't quite come down to the bottom of the channel. So we've established now that we have 1, 2, and then this was our third touch on top. We have only 1 touch on the bottom, but almost back down to it here as well. So I'm looking at this channel right here, but inside of that channel, we have established what is a descending wedge. So this descending wedge, that was our top, that was our bottom, that was our top, that was our bottom. So we have 1, 2 touches on the bottom on the 4-hour, and then we have 1, 2, 3 touches on the top on the 4-hour. So when we came back up here and attempted to break out the top, we failed to break through it. We got a push up here, and then we essentially got a hammer doji, which means that we sold where we got bought all the way up outside of the pattern, but right before it closed, price got hammered back down, and then we left this big tail with a tiny little body, which typically is a rejection of higher prices. We moved up to higher prices, and then people used that as an opportunity to sell into it, rejected it back down. I took a short position off of that area with 2 targets in mind, and I'm going to explain to you about risk reward in this video. As you notice, you know, I try to teach a little something at least every single video. So we're going to show risk reward. I chose the entry point right here based on a shorter time frame, but I chose the potential stop loss location as a slightly higher high outside of the pattern without confirming essentially that we had broken out of the pattern, come back and retest, and we were going to get the measure move to the upside here in blue and then re-enter this larger pattern that we had broke down from. So basically that was a 2% stop loss to the upside. We came up almost to my stop loss and almost exited me from this position, but it was saved just slightly above it, which is why I put it there. I want it to be just above this previous point right here that we broke down from. If we take out that point, that was essentially the highest point that we had inside this downtrend without coming all the way back up to the top and reconfirming back inside of this support zone that we broke down from. So once we come all the way up there, that's a 2% stop loss if we get taken out of the trade, and then we just continue to the upside, and that's perfectly fine. That's our risk, is 2%. Now down here on reward, you'll see basically I have chosen the measured move, which is essentially from the entry point, from the top of this pattern right here, down to the bottom of the wedge, which is this purple arrow right here leading down. So essentially it's just coming back down to the heart line of this channel, this descending channel, or coming back down to the support level of this wedge that we had established. So that's going to be a 5% potential move to the downside. So the way you calculate risk reward is we have a 2% risk, we have a 5% reward. So we essentially have a 2.5 to 1. If we win, we get 2.5 times as much as if we lose. So we're losing potentially 2%, we're gaining potentially 5%. So you divide the 5% win by the 2% loss, and you get your total, which is going to be 2.5% or 2.5x, which is what we're going for. We want 2 or more times as much potential gain as we have loss. That way we can literally flip a coin over and over again. We can take the same trade 100 times. We can be right half the time, but when we're right, we make $2.50 for every dollar that we risk. When we're wrong, we lose $1 for every dollar that we risk. So essentially, if we take that same bet or that same trade 50 times, or let's say 100 times just for simplicity, if we win 50 times and we lose 50 times, we will lose $50 because we lose $1 every time off of our, say, $100 position. And then if we win, we would win 50 times as well. But each time we win $2.50. So that's going to be a total of $150. So then we minus out the 50 that we lost from the 150 that we made, and we win $100. So when we take that trade 100 times in a row, our $100 position becomes a $200 position. We essentially double it up. So that's the coin flip theory, that if you're right 50% of the time and you have no advantage on the market, but you use your risk reward to take intelligent trades, you can be successful in time. So then if we take from that same point and then we assume that we're going to get a larger measure move to the downside, that larger measure move in the same situation. All right, so if we take that same trade right here, but we have our second target in place now, we have a 2% stop loss to the upside, same exact stop loss, and then to the downside, we have a potential reward back to the bottom of that channel that we had identified here to touch the bottom here as well, and that's going to be a 10.8% move. So essentially, once again, we take that 10.8, we divide it by the 2, and we essentially get a 5.4 to 1 risk reward, roughly. So basically, we have over 5 to 1. So again, if we take that exact same situation, we have a $100 position, we win 50, we lose 50, we take the same trade 100 times, we're going to lose $50 by $1 each trade, but we're going to win 5.5 times our 50. So essentially we're going to make $550 and then we're going to lose our $50. So we're going to end up with $500 net gain on top of our $100 position. So you can see that by taking a higher risk reward trade, even with the 50% chance of success, that over time we will always win. And that's the beauty of technical analysis is you're taking trades based on support and resistance. You're selling resistance. You're buying support. You're identifying clear targets for risk reward. And then you're using a small position, risking a small percentage of your overall position to gain a larger percentage. So if you sit here and flip a coin with your buddy, 100 times in a row, and he wins $1 every time he's right, and gets tails or whatever, and you win $5 every time you're right, and you get heads, same thing. You're gonna win. Oh, I might have said that wrong. It's 250, I think. You're gonna win 250, and then you're gonna lose 50, so you end up winning 200. So essentially, your position is 3x. So the whole idea behind risk reward is that by taking a higher reward compared to a lower risk, you are going to benefit and win over time. So then if you can increase your likelihood of success above 50%, your gains are exponentially higher, because by always taking at least a 2-to-1 trade and always winning at least 50%, as you go to 55 and 60 and even potentially higher percentage chance of winning, you're exponentially going to do better over those 100 trades. So that's the idea behind risk reward. And then obviously, like, position sizing is extremely important as well. It's why I don't trust anyone that says I'm all in or I'm bullish on a single asset and I'm betting on that one asset, because that's essentially what you're doing. You're just betting at that point in time. You need to have, in my opinion, it's not financial advice. I'm not your financial advisor. Markets are extremely volatile. Anything could happen. But essentially, by diversifying your position into different assets and different asset classes, you're saying that over time, that even if there's some black swan event, typically that you're still going to succeed as long as you stick to your rules. And it's important that when you develop a trading plan, that you essentially have clearly defined rules, so then every time before you take a trade, you can pull out your trading plan and just go down the checklist and make sure that you're following all your rules. If you are, just like a mechanic, just like a machine, just like a robot, you can take that trade because you've already determined that if you take this trade 100 times and you win 50 of them, you'll succeed. If you win more than 50 of them, you'll succeed even by more. But by essentially identifying risk reward, probability of success, and position sizing, you will be more profitable in these markets through, basically like technical analysis, not just essentially saying, this guy said that Plan B's plan is going to take us to $1 million, so I'm all in because that's what he says. Well, what happens if we take a 90% drawdown and then we go to $1 million? Are you going to be able to stomach that? Are you going to be able to take your $40,000 Bitcoin down to, $400, $4,000, $10,000? At what point in time are you going to call it quits and say something failed and then potentially miss out on the whole bull run because you got scared out of your position? I would much rather use technical analysis, get in and out of trades, or hedge my position where necessary. That way I protect myself from those situations so I don't have to make that decision on, a whim. Essentially, do I need to exit this position? Did something go wrong? Was there a failure in the system? Was there a failure in my analysis? Was there a failure in the asset class? Essentially, that way you're using measured success to basically like make your decisions. So you'll notice here also I have this red line to the downside, and this is essentially a descending broadening wedge inside that same position. So we have a descending tightening wedge right here because it's going downward over time, but it's slowly contracting, getting smaller and smaller and smaller. We have also a descending broadening wedge with the red line here and the tan or orange line here, where essentially it is going down, but it's getting bigger and bigger as it goes down. And then we also have our channel, which both of those patterns fall inside of. So essentially what we're looking at is three potential patterns, all which are currently being respected. The channel is the least valid because it has the least touch points on the bottom, as where it has all of them have 1, 2, 3 touch points on top. But you'll notice that the descending tightening wedge has 1, 2 touches on the bottom with quite a bit of confluence, and the descending broadening wedge has 1, 2, potentially 3 touches on the bottom, and then again 2 on top there. So we're essentially looking at these three patterns to see how they develop, and then we're identifying the measure moves inside those patterns. So now let's go down to an even shorter time frame, and you'll start to see as we go to shorter and shorter time frames how much more these patterns develop and how much clearer they are. So essentially we were bouncing off of this heart line of the channel, one time here, 2 times there. We found it as resistance now here. So we have 1, 2 supports. We have 3 supports right here. Then we have resistance right here. Resistance right here. Come back down to it. We have support through here. Come back up. We have resistance through here. Break down from it. And now we have resistance again. Break up through it. And now what I would expect to happen is come down to it and find support. So that is going to be our first take profit area for the 2.5 to 1 risk reward trade right here. So when we come down here and we touch that, I will take profits on a portion of my position. A lot of people will take 0.25% of their profits, 25% of their profits, or 1/4 of them. Some people will take half of their position off the table. Other people might take the entire position off the table. I would rather let my winners run and my losers I cut short. So if this potentially continues on here and then comes back up, I will move my stop loss as we continue on some of the position. It's called the running stop loss. So I will have my stop loss up here, and then once I'm in a nice profit, I will move my stop loss down to another key resistance area. So then if we bounce back up and touch that resistance, it will take me out of my position, but I will still have locked in these gains right here. But I also like to take part of my position off the table when we hit my target. So when we hit this breakdown target right here, I will take a percentage of my position off the table. I will then move my stop loss on a percentage of my position down to another key fib level or resistance level. And then if we bounce back up, it would take another percentage of my position off the table. I'll lock in the profits on part of the position for the entire move. I'll lock in the profits on part of the position for the small portion of the move. And then in the event that it breaks back up and then hits my original stop loss right here, I will be taken out of the position at break even on the remainder of my move, assuming that we have broke this pattern and we'll be continuing to the upside. If that doesn't happen though, my position will stay open, and then I will potentially get to take profits on this entire measure move to the downside, which hits many of our confluence levels from previous videos, as well as this one, which again is going to be down to that 32,000 range. So there we have essentially that. Now you'll notice once again that we have a pattern inside of a pattern. We have 1, 2, 3 drives right there, all 3 hitting that top red resistance line, and you can see it even clearer on a shorter time frame as well. This is like a small scalp that we're essentially paying attention to. We have a single wave up, 2, we have a third wave up, 3. So when we get that 1, that's our 2 retracement. We get that 3, we get that 4 retracement. The 4 retracement does not go lower than the 1 on a longer time frame, in highly leveraged markets. And then we get our 5th wave up to the upside. When we get that 5th wave up, hits a key resistance, 1, 2, 3 resistance points, sells back off. So then we can Fibonacci from the bottom to the top. We can use our measured moves to determine how far we think it's going to come down as well. So in this case, if we took from the bottom right here to the top right there, what we're paying attention to now is this green Fibonacci that we just added in. And you'll see, I'm going to actually make it a little brighter while we're looking at it specifically. So you're going to see this green Fibonacci right now. When we broke down from the bottom line, which we had 1 test, 2 tests, and then 3 tests, we stopped right at it, and then we closed below it, attempted to get back in it multiple times in a row, started to sell back off to the 382, came all the way back up to the 236. So when we came back up to the 236, we were retesting the breakdown. So we had a support, we broke from it, retested as resistance, came back down again to the 382. So you'll notice the confluence between the 236, the 382. As soon as we sold off this candle right here that's happening during the video, came down exactly to the 0.5. So now potentially what's going to happen there, we'll attempt to get a bounce back up, retest the 382 depending on how strong the markets are, and then go down to our next Fibonacci target, which would be the 618, which is 34,974, and then potentially come all the way down to the 786, which is our target. I'll take profits slightly above the measured move because I like to front run the targets to make sure that I get in and out of my positions. Because the last thing I want to do is have it come down 99% of the way to my position and then bounce up and I give back all those gains. So depending on how strong or weak the markets are right here is how violently we'll sell back off and how far or close we'll make it to those targets that we've identified here as well. So you'll notice that those Fibonacci's will come into account here, over the next few hours. Especially on these shorter time frames, and we can see, are we going to hit the measured move here? Are we going to get continuation and hit the larger measured move? Or are we going to be wrong and then it comes back up and takes us out of our position? But at this point in time now, we essentially have this clear resistance breakdown here. So what I'll do is I'll move my stop loss to slightly above that position to like that 35,846 range. So in the event that this bounces back up, it will take me out of the majority of the remaining position. I will lock in the gains from where I'm at currently, potentially lock in the gains all the way to the bottom. But if I'm wrong, I get taken out of the trade with a very slight profit, just enough that I don't let a winner turn into a loser. Because right now I was right about the direction, but if it comes back up and takes me out of the trade, I essentially gave back the gains that I would have potentially made. So at least this way I have a free trade. I'm entered into a trade now for free without any possibility of taking a loss. So in the event that we get a massive sell-off, I'm already in that position and there's no way I can lose. In the same way that I would like to take a long position from the bottom of the range and end up in the exact same situation where I'm in a trade with no chance of losing. So now if we switch off, what I want to do here as well is I want to go ahead and turn off the drawing tools, and go to the regular chart here. And I want to talk about something that we identified here in a previous video that I've been clearly stating out over and over again that has been an easy and profitable trade. And what that is, it's buying the 21 daily moving average. So we bought it down here once below it, twice, 3 times you could have bought it, and then this was the 4th time we came down to it, bought it, and we got each time a smaller move than the previous. Here we bought it and got the move up to here, took profits on the majority of the position, and then came back down, re-entered that trade again, came all the way up to the top. We then entered a short position to hedge our long position here so that if it dropped back down, we did not lose any of the profits that we had gained on the way back up. So now we have that open short, as well as we took a long position down here again off the 21. And each time we've gotten rejected at a lower point. The first time rejection was up here. The second time our macro rejection was up here. And now here we got rejected. This time, the same way we got rejected on the 8 daily moving average, we've gotten rejected again. We'll come down to the 21. But this time, we're losing the potential gain each time as it tightens and tightens and tightens. And if we go sideways long enough, we would expect it to break down from this range and then overall hit that macro target of 27,938, 28,000 basically. And that would be a retest of this wick breakdown from the 20% move that got bought up before that parabolic move. So we essentially got sold off, it got rejected, sold off, it got rejected, but lower. So if we sell off again, we would expect it to get rejected and then come back up and retest the 21, this time as resistance. So now we're using the 21 as support where we buy, and we're using the 8 as resistance where we sell. So if we break down from the 21, we will then use the 55 exponential as support where we buy, and then we'll then use the 21 as resistance where we sell. And in the event that the 8 crosses below the 21 on the daily, that will mark to us that the long-term trend has overall changed, and we're possibly going to enter into a long-term correction, at least longer term, because we'll be looking at the daily instead of the 4-hour. But just like we spoke about before, when we came down to here and we took this buy off of this area right here on the 4-hour chart, what we were expecting to happen was essentially we get that cross down here, we get bought up off of our 89 moving average, we expect it to come back up, and then we sell back off, take a buy here again off of this range, and then we come back up, and exactly like I said, we would come back into line with futures one way or the other. Futures opened back up at a little over 36,000. I think it was like 36,300. Bitcoin price moved all the way back to 36,300. Closed that gap that would have potentially been open on futures, and then started selling off again. Now this 89 moving average in purple has acted as support quite a few times in a row, so I don't expect us to just blow through it, but if we consolidate here long enough, we've already gotten the 8 and 21 cross to the downside. We're now crossing the 21 under the 55. We've already crossed under the 50, so the next thing to happen would be on the 4-hour time frame to break down from the 81 and come down and retest the 200 exponential and the 200 simple, and that's going to line up once again with this clear support area that we've put in here as well, which is going to come in right at that 31,250 range. So once again, we'll be looking to long support. We'll be looking to take a buy off of the support area. We'll buy spot down here. We'll close out some of our short positions to take profits on those positions as well, or we move our running stop losses down so that if the price action does get a reaction rally back to the upside, it will take out those positions. So you'll see that the key to what we do here on this channel is we don't just pick a target or listen to, someone saying that Bitcoin is going to go to $1 million or $100,000 or $300,000 by end of year. We look at the chart and what it's telling us. We identify clear indicators of what the price action, what the indicators and oscillators are telling us, and then we use our knowledge in the markets to make educated trades based on that. The idea is to not sell our spot as much as possible and then use the macro moves inside of the micro price action. Use the micro moves inside of the macro price action to take profits along the way. So we didn't just ride this all the way from $4,000 up to $40,000 and then just not take profits on our position. So if it sells all the way back down to $10,000, we basically could have had $30,000 minus taxes, but instead we just have our $10,000. So instead of 4,000 to 40,000, which is 10x, we have 4,000 to 10,000, which is 2.5x. So essentially what we're doing is we're locking in profits along the way as price action moves, so that no matter what happens in the end, we'll give back a portion of our profits, but we never have to sell any of our spot position. Therefore, we don't have to worry about a taxable event on our large positions. And then we can just pay taxes on our net gains and losses on the positions inside of these little moves inside of the market. So in my opinion, that's the best way to trade, because you're avoiding as many taxable events as possible. You're holding long-term positions, or hodl positions as people like to say, but you're locking in your gains along the way using micro scalp positions or short positions, long positions on shorter time frames inside of the overall macro moves. So once again, we're going to look at our indicator oscillators here on the 4 hour, and you'll notice that we had our high up here. We broke down from it. We got our histograms. We broke the slope line, and now it's red. Came back up, attempted to break back above it. Broke above it but could not flip it over blue, attempted to break back above it but could not even get above it, attempted once again to get back to it but could not get to it, and now here we're potentially looking for what we call the waterfall, which is where it just slowly basically comes to the edge of a cliff and then just drops straight down off of it. So I'm expecting at this point in time smaller and smaller moves inside of these moving averages, and then finally a violent break based on the pattern that we have right here. This is a descending triangle. We have a high, we have a lower high, we have a lower high, and then we have a flat bottom support basically inside of it. So typically this will break to the downside more than 60% of the time, and it will break to the upside less than 40% of the time. It does not mean that this can't break to the upside and hit that measure move that we had identified, but it means that the likelihood, the percentage chance is higher that it will break to the downside. So again, if we're going to flip a coin with our buddy, that means that 2 out of 3 coin flips, we're going to be right betting on the downside, and 1 out of 3 coin flips will be wrong if it goes to the upside. So then if we use risk reward of 2 to 1 or 5 to 1, and then we use the multiplier of 2 to 1 or, essentially like likelihood of success, we basically have exponential modifiers of our gains. Because if we have a 66% chance of success, and then we have also a 2 to 1 risk reward ratio or higher, that means that if we flip that same coin 100 times, we're going to win 34 times. We're going to win 66 times and lose 34 times. And if we lose $1 every time, we'll have lost $34. If we gain $2.50 every time, our 66 wins will then turn into basically $150 minus our $34. So we'll have $115 of our $100 position. So we'll have over doubled our money with this, strategy. So when you combine all these different things using moving averages, using Fibonacci's, risk reward, likelihood of success versus failure, the coin flip theory, essentially all these different things coupled together form your trading plan. And then when you put into things like position sizing and technicals and even some fundamentals along the way, you can essentially identify your likelihood of success, your profitability, and over time, the same way a casino wins by having a slight edge on the market, you will also have a slight edge on the market, so you will succeed. And then in the event that we do get a massive move to the downside, your gains will be exponential, the same way that when you get a massive move to the upside, like a 10x, your gains once again will be exponential. So if you're going to potentially 10x your position, you can afford to give away a few percent here and there on a short along the way and be wrong, because macro, you're right. In the same way that when we take profits here at this $40,000 range and we start entering short positions, all we're doing is hedging our position that if we do get a massive sell-off, we don't give back a large portion of our gains, but we still have the same amount of Bitcoin. So if we get a 10% move to the downside, but we lock that in with the short, and then price moves right back to where it started at, we now have the same amount of Bitcoin we originally had. The price went down. We ended up with 10% gains from our short. We bought more Bitcoin potentially, or we have extra cash sitting on the sidelines. So our one Bitcoin that was $40,000 becomes worth $30,000. Then it moves back up to $40,000. So now we still have one $40,000 Bitcoin, but we also have another $4,000 sitting on the sidelines that we can use to either pay bills with, we can use to pay, to enter another position with, we can use to hedge our short position, we can use to buy altcoins. We have, unlimited opportunities that we can then do with those gains, but they are locked in the event that we do continue to sell off and we get a 20% position, sell off like this one. We can essentially lock in 20 or 30% gains on that $40,000 coin Price then moves back to the upside, and now here we have an extra $12,000 that we can do whatever we want with off of this gain right here, off of a 30% move, and then we can then still have a $40,000 Bitcoin. And if we do the same thing right here, we make another 10%, that's another $4,000 we can mess around with. So we have 12,000 here, we have 4,000 here, that's 16,000. Our Bitcoin is still worth, one Bitcoin, but it was worth $40,000. Now it's worth less, but we've locked in those profits. So we can potentially wait till we get another retracement down to this area. If it goes down to 30,000 again, we can then use that $16,000. We can buy another half a Bitcoin. And then eventually when we come back up to that $40,000 range, we'll have one Bitcoin that's still worth $40,000. We'll have another half a Bitcoin that is now worth $40,000. So now we've turned that $40,000 position up here into a $60,000 position when we retest it. If we get a substantial sell-off as well, we will continue to profit on the way down, but never have to sell off of our spot position in Bitcoin. And that's the beauty of using trading micro moves inside of a overall macro position. So you can see what we're paying attention to. You can see that we're potentially looking at getting a cross of our stochastic blue back to the upside. But again, we have to wait until that happens. We want to wait and see if we see any divergence developing in the markets. If we sell off to a lower low and get a close, but we have a higher low on the oscillators or indicators, and then vice versa. If we have a higher low on the price action, but we have a lower low on the indicator oscillator from this point to this point, from this point to this point. So now, what we had spoke about briefly in our last video and what we wanted to pay attention to is potential changes in the trend. And what had we talked about? The best buying areas would be, this is the 1 hour I'm looking at now, and this is what I was specifically talking about in the last video, this happening. The best position opportunities to take a long position were when we touch these green areas and we got the bearish control zone, because overall we're in an uptrend. So we have all these times where it's red where the bulls are in control, and then we have very few of these times where it's green when the bears are in control, and those are the best times to take a position. So you'll notice that when we sold off right here, we got that green area, and that was the best time to take a position, was when we exit this green area, and that took us back up. But what we're paying attention to now is we were unable to get above the 200 simple moving average and 200 exponential moving average. So once we sold down below them back here at 36,000, we told you we're not going to be able to get bullish in these markets on a short time frame until we're back above them. And even then we have to be skeptical. So we sold off, retest the moving averages, sold off less, retest the moving averages, broke above it, found support, continuation, topped out at a key fib level, put in essentially a shoulder, neckline, head, neckline, shoulder, breakdown from it. The measure move took us down to the 377 moving average and back below the 200 moving averages. We came above the exponential, but got rejected on the blue simple moving average here. Bounced it, rejected again at the blue simple moving average here. Came down this time, lost the 377 as support, almost came down to the 528, broke back up, retested the 200 moving average exponential and simple again, failed to get above it at all this time, and then got rejected again. So what we would expect now is a move all the way down to the 528, our next target being that 33,500 range. If we break down below that, we'll look at that as a buying opportunity. But what we're paying attention to now is, are we going to be potentially getting more and more of these green areas where the bulls are losing control and the bears are taking control? Because you'll notice all through this area, the bulls are in control almost all the time, over probably 50% of the time. Then this is neutral through here. Bulls are in control, neutral, bulls are in control, neutral, bulls are barely in control. Then the bears are starting to take control. And now if you look at these two last times the bulls were in control, they were in control less than the bears were in control. So what's going to happen here? If we sell down to this 20 level again and the bears are in control again, we really need to start paying attention to, are the bears taking over in this market, and we're going to get an extended downturn. And then we're going to pay attention to longer and longer time frames to identify what's happening in the markets. If this sells back off here and the bears take control, that will be the first time that the bears will have control since back in December 9th. And then the time before that was November 27th. And you'll see they were both just slivers of green, and we have all this red where the bulls were in control. So if we come down here now, that's going to be an excellent buying opportunity, probably off the 200 moving average, which is overall the best potential buying opportunity that we have in any market. Because as long as you're above the 200 moving average, you want to use that as support. You want to take a long position off of that, in the same way that if we're below the 200 moving average in a bear market, we want to use that as a selling opportunity and take a short position. Again, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So there we have, these moving averages are getting tighter and tighter and tighter, and if we stay here long enough, we're going to get a violent move in one direction or the other. The keys will be, if we break down and start taking out these previous lows, we have a high here, we have a low, we have a lower high, we have a lower low, we have a lower high, we potentially come down and put in a lower low, and then if we lose this moving average, we're going to get a violent sell-off. And then again, if we flip over to the next longest time frame and go to the relevant time frame and go to the daily, that's going to line up perfectly with an attempt to save this 34,000 range and the 21 daily moving average. But if we break down from that, we could expect first a potential move to our previous wicks down here at 30,000, then potentially down even lower to that 27,000 and the 50-55 moving average, which then we will assume these will act as support, take the buy off that range, and then try to get a retest of the 21, and we will sell into the 21 because this is our support area now, this is our resistance area now, in the same way that this was our support area when we broke down to it, and the red moving average was our resistance area. And then again, once we finally flip these back over to the upside and we're back in an uptrend, we will use all these as support again, in the same way that if we flip these to the downside and then we break down from the 50-55, we'll use the 89 as support, and then they will act as resistance. So, and that is what we call an SR flip. It's where support becomes resistance or resistance becomes support. Typically, this area, based on the indicator oscillators down here, typically we will get a bunch of these histograms in a row to the downside, and then we'll get an attempted bounce one last time to try to save this price action off of the blue slope line. If we fail to get back above that and save this and continue to the upside, if we're underneath it long enough with these histograms, we're going to flip this over red again, and then we'll enter a consolidation or, retracement zone. And that's when we need to be really careful that this is potentially flipping the overall trend. Because once again, if we look at the daily trend, the last time we flipped the 8 under the 21 was back on September 2nd, and that was back at $11,500. So we could potentially get a massive move to the downside. It's still possible we break down from that 21, find support, and then we're able to save this 8 and 21 and get continued move to the upside, which is when buying that support will be beautiful and we'll get that continuation and we'll have the best entrance, as we're selling the resistance if we break down to this area and find a lower support area will be the perfect, basically this will have been, these two shorts will have been the two perfect entrances for a short or a hedge position to the downside if we get continuation. So hope everything was clear. If you have any comments or questions, please feel free to ask them in the comments section. If you have any specific cryptos or anything you'd like me to do technical analysis on, or you'd like me to speak specifically about something as far as, something that I've went over about how to do technical analysis, or if you have any questions or anything like that, please feel free to ask them as well. I do appreciate the interactions, guys. I think that's basically it. Make sure you like and subscribe if you're new to the channel. I know this is overwhelming. Slow it down a little bit. Watch it. Ask questions. Watch my old videos, because although the price action is not always relevant because we moved so much since then, every single one of them is full of a lesson. A free lesson that will help you get better in these markets. I also highly recommend that you check out the Crypto Trend Trader indicator series. Inside of the indicator series, you will find a bunch of personalized lessons that I did for my Discord group that basically teach you everything from basics to advanced techniques, and then not to mention the actual indicator tutorials that will teach you specifically how to use every single one of my proprietary indicators. And again, if you're interested in using those, I am on TradingView, and you can go to TradingView and you can essentially activate those same indicator oscillators on your chart, and you can use all them absolutely free. And if you want to show your support, there are links in there for Bitcoin and Ethereum. I do highly appreciate it, but it's not necessary. I do appreciate anyone that likes, shares, and of course subscribes. So there you have it, guys. Crypto Trend Trader with another market update on Bitcoin, and I'm out of here.